Federal Reserve out with its July statement. The Federal Reserve holding interest rates at near zero, but an interesting update from the Federal Open Market Committee with regards to its approach to its asset purchases. Keep in mind, it's been buying about $120 billion a month in U.S. Treasuries and agency mortgage-backed securities. The Federal Reserve now noting in new language in its statement that, quote, since then, meaning the December time frame where the Federal Reserve had said it was looking for substantial further progress in the economy before paring back those purchases, quote, the economy has made progress towards these goals, and the committee will continue to assess progress in coming meetings. This is a inch, if you will, towards the Fed at some point paring back and slowing that $120 billion a pace of purchases. Now, again, that is new compared to the Fed's last statement in June, where it said that it was continuing to pay attention to how the economy was unfolding. As far as its outlook, the Federal Reserve noting that progress on vaccinations is continuing. They said strong policy support has led to indicators of economic activity and employment continuing to strengthen. And then interestingly, on the inflation front, no change to the way that they saw price pressures. They continued to describe and attribute inflationary pressures to, quote, transitory factors. So the Fed not budging on their view, at least from the committee standpoint, over inflation not necessarily being at runaway levels quite yet. But they did note that a number of sectors look like they've shown improvement but have not fully recovered. So again, the big news out of the statement, really that the Fed is providing more granular detail on how they do see the economy getting closer to a place where it might be able to sustain fewer and reduced asset purchases from the central bank. Now, another kind of in the weeds point that I want to make beyond the fact that the decision, by the way, was unanimous, so there were no dissenters, at least on the statement itself, is the Federal Reserve's announcement alongside this that it will be standing up what they call a standing repo facility. So if you'll just give me a few seconds to walk you through this. Effectively, in the depths of the pandemic, there was a huge dash for cash. In March, there were a lot of counterparties that were looking to liquidate even what is considered to be the safest asset, that's U.S. Treasuries, and try to find cash. The Federal Reserve was only able to offer liquidity to primary dealers, which meant that a lot of people trying to sell Treasuries ultimately ended in a very weird dynamic where yields were not necessarily going in a way that people expected when people are trying to go on risk-off behavior. So the Fed announced that they'll be setting up this so-called standing repo facility. There will be two of them. One will be domestic, and another one will be foreign. To provide liquidity to those that are abroad in another stress event in the hypothetical future where people may be looking for U.S. Treasuries. They announced pricing and operation sizes for those standing repo facilities. And again, this is supposed to be a way to grease the wheels to make sure that the U.S. Treasury market doesn't endure any sort of weird dynamics like it did last year. But again, fairly in the weeds stuff. The big headline, no changes to the Fed's policy and maybe one small step towards tapering, guys.
Brian, anything in there talk about how the Fed is seeing these supply chain bottlenecks and rising COVID-19 cases and how they may cloud or threaten the economic recovery?
Well, nothing too detailed in the statement. We'll probably get a little bit more color when the Fed chairman has his press conference in about 27 minutes or so. But obviously, when you take a look at the language, no change might be something noticeable. Again, the Federal Reserve not changing its language in the statement between 6 weeks ago and now with regards to seeing inflationary pressures as still attributable to those transitory factors. Now, this is kind of interesting because we actually saw the Fed chairman appear ahead of Congress about 2 weeks ago, where his prepared remarks to the House Financial Services Committee and the Senate Banking Committee had no mention of the word transitory. There were some Fed watchers that were gleaning from that omission that maybe the Federal Reserve was departing from its House view that these inflationary pressures, like, for example, supply chain. Another example would be the base effects of measuring current months to the deep months of 2020, where there were actually price declines. It seems like the Federal Reserve is still standing pat on their view that inflation is likely transitory, despite the fact that we saw a consumer price index print for the month of June that was the highest that we had seen since August of 2008 on a year-over-year basis. So again, it'll be interesting to see if the Federal Reserve chairman in his press conference tries to add a little bit more nuance to that, because we've heard from a number of other Fed officials, including Fed President Eric Rosengren from the Boston Fed here on Yahoo Finance, that some of these inflationary pressures might be incentivizing Fed officials to pump up pull forward those discussions about maybe tapering and then at some point raising interest rates.
All right. Fed reporter Brian Cheung, thank you so much, as always.